Hey, Brittany, when are we going to get this thing started? I'm ready to go. I see we have attendees, but the dummy isn't here yet. He calls me a dummy. At least I'm a better presenter than he is. If you're watching this, please come and save me. Please. Oh, there's a lot of you there. Don't you have anything better to do today? All you're going to do is watch this guy confuse you? He doesn't understand this stuff. I'm always explaining it to him. And today will make your head spin. So, without further library books being ado, hello. Oh, hi. Time to get started. Bye. All right. Welcome to today's presentation. I am Alan Gassman, the real dummy, and we're talking about estate tax planning from basic to beyond, part 2. If you are booked in through CPA Academy, you will get 1 hour of CPE credit, whether you deserve it or not, and whether you learn anything today or not. And if you're here actually to learn, well, then I hope you learn a lot. I know I will. So let's go forward here. If you have any questions, you click the upside down pyramid, stand upside down on your head, and type the question out, and we will try to answer it. Also, you have my email address here, agassman@gassmanpa.com. I'm a lawyer in Clearwater, Florida, but you'll have to forgive me for that. If you like this and you have low standards, you can go to our website on YouTube and play these. If you play these 1,000,000 times, then I will get a check for $69.95. This is a continuation of part 1, which was filmed February 18, 2023. That was before President Biden's new proposal that came out this week, but it's still a pretty good webinar to watch. I would watch this part 2 first and then part 1 to make sure that you are plenty mixed up. Also on YouTube, last week's presentation, our interview and discussion of success with Patty Boyd, the first wife of George Harrison and the former wife of Eric Clapton. They were husband-in-laws or something like that. Interesting to me, at least, if you want to watch it. And our series on asset protection from A to Z, parts 1, 2, and 3, complete with Mortimer Dummy. Okay, so also, I would like to see you May 18th, 2023 in or near Dayton, Ohio for a nice full conference we are having to support the Ketterling Hospital System. And speakers will include Clary Red, me, Jerry Hesh, and Jonathan Blottmacher. The morning, we're going to talk about estate planning and estate tax planning. And in the afternoon, we're going to talk charitable planning. There will be a online alternative, but if you want to see the Wright Brothers Museum and the Air Force Museum, they're in Dayton, Ohio, you'll want to go there personally. That is what I'm going to do. So on the new estate tax changes and income tax changes proposed by President Biden this week, we will be covering this in a LISI webinar next Friday. And if you have any questions on that, let us know. And on CPA Academy on March 18th, we will be talking about the new pension IRA and other rules under the Secure Act 2.0 with an actuary, Stephen Evers, who is a very good communicator. He forgot to go to the actuary non-communication classes that they give for actuaries. You know the old saying that an actuary is somebody who wanted to be an accountant but did not have the personality for it? Well, Stephen is an exception to that rule. He does a great job of explaining how pension and IRA rules work, and I'm really looking forward to it. So enough of our shameless self-promotion. If you're still awake, you're asking me, well, what is President Biden looking to do with the estate and gift tax system? He's looking to do a lot if he can get Democratic support and someone to cross the aisle from the Republican Party, which we know is not going to happen. So my favorite book is Catch-22 by Joseph Heller. That's not going to happen. And what I'm about to tell you is not going to happen anytime soon. But it does tell you what the administration is looking at. And it would be possible that in order to get other things done, that Republicans may cross the aisle to allow one or more of these things to some extent. So the first item is more people other than just the personal representative of an estate may be responsible if you don't pay the estate tax. That's not going to be a surprise. Secondly, farmers, ranchers, and timberland owners will get a better tax deal on the ability to lower the value of those properties on an estate tax return to the extent of up to 13 million. I think right now it's 2.5 million. The IRS will have a 10-year statute, longer than the normal 10-year statute, to pursue liens. And it's funny, tenure, T-E-N-U-R-E, nope, that's just a mistake. Then domestic and foreign trusts, even disregarded trusts, would have to start filing information returns with the IRS so that they can study what these trusts are doing and not doing. Then they would restrict or eliminate our ability to use defined value formula clauses. Right now, and the standard of practice is that if I want to give stock worth $10 million to a trust, and I'm afraid the IRS will say it's worth 20 million and I could owe a gift tax, I use a formula valuation clause which say I hereby give a sufficient number of shares of stock to equal $10 million in value. And if a court of competent jurisdiction decides that it's really worth 15 million, then only 2/3 of it will be transferred. And under the Wandry case, W-A-N-D-R-Y case, at least one tax court judge believes that that will work fine. And we have good evidence that other tax court judges have the same belief. Well, the IRS doesn't like those clauses, so bye-bye Wandry if President Biden gets his way. Page 21, right now there's a $17,000 per person gift tax exemption. I could give $17,000 to 100 different relatives and friends and get $1.7 million out of my estate each year. Well, they would limit that to 50,000 total, but I could give 50,000 to my daughter and nothing to anyone else, or I could give 50,000 to a trust. So that could simplify, but it will hurt most families. Then generation skipping trusts would only be able to go transfer tax-free for up to 2 generations. So grandpa dies, he leaves $10 million worth of assets in a trust. It benefits his children for their lifetime. They die, no estate tax, no generation skipping tax. It benefits his grandchildren. They die, no generation skipping tax, no tax. Then it benefits his great-grandchildren. They die, oops, estate tax or generation skipping tax at that level. And this would apply to existing trusts. So I don't expect this one to pass, but it's interesting to see it proposed this way. You know, Bernie Sanders and President Biden had proposed reducing the estate tax exemption significantly, doing away with what we call grantor trusts, restricting grats. He's not asking for any of those things, but he wants to restrict these GST trusts and apparently ungrandfather them, which is sort of unprecedented. You normally don't ungrandfather somebody or a technique. So I think that in itself is worthy of discussion. And then he would restrict charitable lead trusts. Now, this will hurt charities. He says charitable lead trusts will have to only pay a fixed annual amount. They can't pay a little amount increasing, and that there has to be at least a 10% gift or estate tax event on formation. So those are the main things, other than to do away with family discounts, and to say that promissory notes can't be discounted under many circumstances. So that's going to get a lot of attention. It deserves a lot of attention. The moral of this story and in the Bible story of Noah is get your planning done. It was not raining when Noah built the ark. We now have a light sprinkle of what would happen if President Biden is reelected and the Democrats control the Senate and the House. Now, that's unlikely, but it was also unlikely that President Trump would have been elected. So who knows? Now, there's more language here, which is verbatim from the Biden plan. So when you see things like this was the most agrarious and fiscally reckless budget ever, that's not coming from me. This is word for word from the Biden budget. Okay. The other interesting thing is the proposed minimum tax on billionaires. And this is why you don't want to marry a billionaire and file a joint return, because then you will have to pay income tax if he gets his way based on 25% of appreciation each year, whether you sell the asset or not. So you wake up one morning, you're worth $1 billion, you invest it, you spend $1 million, then a year later you're worth $1.1 billion. You've got to pay a $25 million tax, whether you actually got the capital gains and sold the assets or not. And this doesn't, you don't have to be a billionaire to pay the tax. You only have to be worth $100 million. There's a lot of people out there worth $100 million. Please invite me somewhere on your jet and worry about this billionaire tax. They're also would do away with the ability to receive dividends from an S corporation free of Medicare tax, and they would raise the Medicare tax for people who earn more than $400,000 a year. So there's plenty there to worry about. If you like to worry, you could put this on your list. To introduce, and by the way, I'll go about 10 minutes late today, and the reason for that is I just spent 10 minutes on the Biden plan and on shameless self-promotion. So ideally, just start watching now. If you have a friend that's going to watch, just tell them to start watching 12 minutes into the show. They won't have missed any good jokes whatsoever. Now, for the first polling question, we set up the National Institute for Charitable Education. It's a 501c3 so that law students could donate time to do professional writing, which will be nationally published on charitable items, and earn their pro bono credit at law schools. So the first polling question is, are you interested in more information on the National Institute for Charitable Education? The answer is A, yes, B, no, or C, what in the heck is that? That's a silly question, Alan. Well, thank you for your opinion. Okay, so that takes care of polling question number 1. I want to remember from 2 weeks ago, one of my favorite tax professors, Douglas Miller, said the first day, the estate tax is a voluntary tax. You only pay it if you don't plan, for the vast majority of families, and also for you billionaires watching. So we're going to show you the Charitable Lead Annuity Trust in the last part of this program, which will basically knock your socks off if you can afford socks after the new Biden tax increase, if it does come to pass. And as we also discussed in our session 2 weeks ago, before you told me about your childhood, the interest rates are coming up. The river is rising. And the hurdle rate, which is what we call the Section 7520 rate, is an important rate. It tells us, and I'll show you later, how much appreciation you need for a grantor retained annuity trust, a charitable lead trust, to make good sense for your family. And that was a 2.2% interest rate in April 2022. You could set it at 2.2. Everything over 2.2% in growth was coming out of your estate. The hurdle rate for one of these today is 4.4%. Now, we expect a higher rate of return overall on real estate and other asset-based investments because of inflation going up. So you may be better off going at 4.4% in March than you would have been at 2.2% in April. But those of you who were here in April before the May showers, which increased the interest rate, did honestly a better job for your family. And then here, the applicable federal rate that we can charge on promissory notes for March, 3.71% for a long-term promissory note, because you use the semi-annual rate for an annually compounding promissory note. And the reason for that is when they wrote the statute, they got mixed up. So thank you for whoever mixed that up. I would like to go now, for those of you who don't know a lot about estate tax, I want to find one of those slides that I wanted to cover. Here, now, 2 weeks ago, I showed you the estate view step-by-step process of determining estate tax and avoiding estate tax. But I want to go over some basics here on page 128 of the slides. So here you have a married couple. They have a very good marriage, and we have creatively named them first dying spouse and surviving spouse. So, you know, their parents were Mr. and Mrs. Spouse, and why they named their children this and their children got married, I don't know. They were actually they were in the same neighborhood. They weren't actually siblings or even cousins, but they got married. So, boy, I walked into a corner there. Anyway, first dying spouse has a revocable trust, and surviving spouse has a revocable trust. And both of those trusts have more than $13 million in them for purposes of this story. And they also each had a bowl of porridge. So first dying spouse, just for the sake of this story, we'll say that first dying spouse dies first and has never used any of his or her $12,920,000 estate and gift tax exemption. So what can happen under this trust agreement, which is magically drafted before they die, like the day before they go on vacation because they called their lawyer 2 days before vacation. And this trust says, to the extent of my estate tax exemption amount, transfer the assets to the family trust, also known as the bypass trust, also known as the generation skipping trust, also known as the B trust, also known as the credit shelter trust. Has my profession simplified this enough for you or not? So that $12,920,000 is held by the surviving spouse as trustee or co-trustee, if you like. The surviving spouse can withdraw whatever he or she needs for the magic words health, education, maintenance, and support. That actually comes from the British common law from 1776. They had those terms, that terminology, which means that the surviving spouse can get what they need to maintain the standard of living enjoyed during the marriage, which could include jet airplanes. Invite me on yours, please. And on the second death, when the other spouse, creatively named surviving spouse, dies, that trust is never, ever subject to federal estate tax in the estate of the surviving spouse, even though the surviving spouse may have what is called a limited power of appointment. And a limited power of appointment is, by definition, and from the English common law, the ability to direct trust assets to anyone or anything on the face of the earth or anywhere in the Milky Way galaxy or outside of the Milky Way galaxy, as long as it cannot be exercised in favor of the first dying spouse, her estate, her creditors, or creditors of her estate. So there's a lot of leeway there, a lot of control, but complete avoidance of federal estate tax, and guess what? Also avoidance of creditor claims. So for a lot of physicians, for example, the physician says, well, my spouse doesn't need insurance. If my spouse dies, there's plenty of assets to support me. Well, could a creditor take those assets? Yes. Well, if we put $12 million worth of life insurance on your spouse, she owns the policy and it's payable to her revocable trust. When she dies, you have a built-in credit shelter trust and creditor protection. Now, on the second death, to the extent that that power of appointment is not exercised, or even if it is exercised, it can go to irrevocable trusts for the children. Now, each child may get their own separate trust, and we would normally call that a generation skipping trust. That is a GST trust, which benefits the child and the descendants of the child, but is not subject to estate tax at the child's estate. Now, there's another blemish on my profession, because why would you call a trust that benefits your child a generation skipping trust? Clients have called me literally in tears saying, I read the trust. We accidentally skipped my children. No, you didn't skip the children. It's just called a generation skipping trust because we're a bunch of morons. I'm talking about members of my esteemed profession. So now, what happens, and I know all of you are asking this, you've just been wondering this from the beginning. Well, I have a lot more than $12,920,000. Where does that go? Well, to the extent that you could set up an irrevocable life insurance trust, it could go over there, and we may talk about that later. But in the revocable trust, there is a marital deduction clause. So let's say that I die, leave with $20 million because of all the royalties I get from speaking on CPA Academy. And $12,920,000 goes to the Credit Shelter Trust for Marcia, kind of cheers her up for things. And then there's another $7,080,000 that goes either outright to Marcia, so there's no estate tax because of the marital deduction, or if I want to protect Marcia from potential creditors, a potential next spouse, who knows what, it can go to a marital deduction trust, also known as a Q-tip trust. Now, clean your ears out. I did say Q-tip trust. She could buy an unlimited number of Q-tips at Walgreens or CVS with that trust in case Q-tips go up in value. Q-tip stands for Qualified Terminable Interest Property. It was invented during the Ronald Reagan era. Before Ronald Reagan, if you wanted a marital deduction, you had to leave it outright to your spouse. Well, Nancy Reagan was not Ronald's first spouse, and he had children by a prior marriage. So he endorsed the idea of a Q-tip trust, and the Q-tip trust says it has to be held for my spouse and my spouse alone during her lifetime. It has to pay all the income to the spouse. It can also pay amounts as needed for health, education, and maintenance. And on the second death, in most situations, not all, it will become a trust for the children that will not be GST exempt, which means it will be subject to estate tax in the children's estate when they die, unless you do some very clever stuff, and sometimes there's no clever stuff you can do. So that is the first dying spouse, also known as Mr. Spouse, because usually the male dies first. Secondly, we have Surviving spouse. What happens to surviving spouse? Well, surviving spouse has a large estate because surviving spouse has been living on the income from the Q-tip trust left by first dying spouse. So a certain amount of that estate can go into a GST exempt trust for the descendants called generation skipping trusts to benefit your descendants and their descendants and the next descendants and the next descendants. How long can that go under the present law? It can go as long as the rule against perpetuities. So when I was in law school, one of my favorite articles I ever read was by Professor Leach, and it's in volume 51 of the Harvard Law Review, and it's called Perpetuities in a Nutshell. And if you think you like estate tax law and you've never been to law school, you need to go read Perpetuities in a Nutshell by Professor Leach, because it was a really good article about a really needlessly complicated concept, and that is how long can an irrevocable trust go? And back then, the rule against perpetuities, which again came from English common law, was a trust can only last as long as a life in being, that's somebody living at the time that the trust is drafted, after their death, plus 21 years. So it was very common to say that this trust will last until 21 years after the death of the later to die of all my relatives who are beneficiaries of this trust and all of the relatives of President George Bush. That was very popular because he had a lot of children, a lot of grandchildren, a lot of great-grandchildren. Well, then they changed that law to be a 99-year law in many states, and now Florida's law is 1,000 years. Delaware's law is infinite, except I think it's limited to 1,000 years if there's real estate directly owned. Nevada is only 360 years. So people from other planets will be thanking us for our drafting of estate tax smart generation skipping trusts. So you say, I'm only worth $1 million, I don't need to do estate tax planning. Well, if your children or your grandchildren or your great-grandchildren may be subject to estate tax, which I would submit to you as likely, then you would leave them assets not outright, but in a GST exempt trust that can benefit your children. Okay, now this can get a little fancier, and everybody has a different plan, but here's one plan I'm working on this week, which is $800,000 will pass to an education-only trust for the descendants of the grandparents of this client. Now, there's 2 or 3 reasons that we like to do an educational-only trust. Number one, I want to encourage education. And if education for my grandson is paid from my daughter's trust, she may not let him go to the best school because she wants her trust to have more. People are weird that way. So if I do an education-only trust, then it does not reduce what my daughter would receive. Secondly, I might want to educate not only my descendants, but also the descendants of my parents or my grandparents, i.e. nieces and nephews. So you could have your lawyer draw a chart like this to summarize your estate plan so that it's easier later to understand. All right, I'm going to do the polling question now on page 70. So here we go. Hold on. There it is. We're going to try Bob Burke's rule again. Now we've misspelled his last name. And the polling question is also incorrect, so listen carefully. For every complicated situation, there's a simple solution, and it is A, the right solution, or B, it is the wrong solution, because complicated situations call for complicated solutions. So B is the correct answer. Actually, B and C together are the right answer. If you could click them both together at the same time, you'll have the right answer. But that's only my opinion, but it's really a cool thing to say to clients because it's usually true. And then selection D is the party you have dialed is not a working number. But the next time you see this, there will only be three choices on it. All right, briefly, very briefly, we've covered annual gifting 2 weeks ago, $14,000 per person per year. We covered, I think, life insurance trusts, or I'll cover life insurance later. I just want to cover, because this is the most popular technique for people who are going to be over the estate tax exemption. And by the way, we mentioned that the exemption is $12,920,000, goes up with inflation, chained inflation, not quite as fast as inflation, but then comes down to half of its intended amount in 2026. In any event, here's a married couple creatively named husband and wife. The next time you see this, it will say spouse one and spouse two. They put $15 million in annuity rights and $4.5 million in stocks and bonds into a Wyoming LLC, and they initially own 0.1% is given to a trust for their lovely grandchildren. This trust controls the right to make liquidations or distributions of the LLC. When you give something away, if you retain the right to decide if and when people will receive it, it may still be in your estate. Under a couple of tax court cases, the first one was Strangi, S-T-R-I-N-G-I, and the second one was Powell, P-O-W-E-L. So, and then there's even a couple of more after that. So we do normally set up an irrevocable trust for the grandchildren. We give it a 0.1% special voting member interest, and we appoint somebody different from everyone else to be the trustee of that trust, and they are replaceable by the husband and wife. So if you don't have that feature now in your estate plan, you might want to ask your advisors whether you should have an anti-Powell special voting arrangement. Now, the clients maintain the 0.9% voting rights, which will give them the ability to manage the LLC, and each of their revocable trusts own 49.5% non-voting. Now, if we do this and nothing else, and let's say husband dies, what is his revocable trust worth? It's not 49.5% of 19.5 million, because what would a willing buyer pay a willing seller for a 49.5% non-voting member interest in this LLC? I would venture to guess that some people would take a 33.33% discount. So 66% of half of 19.5 million is much less than half of 19.5 million. It's about $7 million. So that would reduce the husband's estate tax if he had other taxable assets. That discounted non-voting member interest would go into that credit shelter trust that I showed you. And then if the LLC is liquidated in 20 years with the permission of the gifting trust, there will be a lot more in the credit shelter trust. Now, also, what happens here if husband gets sued? The creditor can't reach half of the 19.5 million unless they live in a community property state and haven't transmuted. The creditor is limited under most states to only getting a charging order against the LLC, where the judge says if husband ever makes if the LLC ever makes a distribution, give husband's creditors 49.5% of the distribution. Well, husband and wife say, guess what, Mr. Creditor? We don't ever plan to make distributions. You can go pound sand or mulch, depending on where you live. And most creditors, most plaintiff lawyers will settle cases really on nickels or dimes to the dollar if all they think they can get is a charging order. So there's a good business purpose for this arrangement. And TBE there means tenancy by the entireties, where if you live in a state like Tennessee or Delaware, Florida, Wyoming, that protects tenancy by the entirety's assets. If you got a judgment against one spouse here, you would never be able to reach any of this or any of the TBE interest. So then you could never, then the voting interest would be protected. So this right here is a simple but good estate tax and creditor avoidance arrangement. Of course, it could be improved, but just want to make sure we're all on the same playing field here. So what can we do that makes it even better and generates more legal and accounting fees? Well, the most popular thing we can do is establish a spousal limited access trust. And in my example, I will put $800,000 as a gift by the husband to the wife as trustee of the spousal limited access trust. The spousal limited access trust says that the wife is trustee, gets what she needs for health, education, and maintenance, goes where she says it goes when she dies, but only among common descendants, and is never subject to federal estate tax, and is disregarded for income tax purposes, which means that all the income and deductions from that trust are going to escape having to be, all of the income and deductions from that trust for income tax purposes go on the husband and wife's personal income tax return. So their payment of those taxes is not considered to be a gift. Now, there's a lot of advantages I just went over. We have a lot of talks on spousal limited access trusts on the YouTube channel, and I know some of you actually understand these pretty well. So I'm just going to go to the next step, except to mention that the husband sets up that trust for the wife sets up a trust for the children only, because I'm concerned with the reciprocal trust doctrine. So whenever you go to a cocktail party and you meet a tax professional, you can say, tell me about the reciprocal trust doctrine. And if that professional says, I need to go get a drink and I'll come back, and they don't come back, probably they just forgot you. So now the next step. The spousal limited access trust, having a net worth of $800,000, purchases 49% of the LLC and dramatically overpays. It pays $7,956 by a 3.88% interest promissory note. Now, it doesn't have to pay that much because you could take a discount there. But after the Biden tax plan, you will be able to do this, but at no discount. So this will still be popular after the Biden tax plan if it passes, but it'll be better if you do it now, take the discount. So what happens in 10 years if you assume 5% growth and the promissory notes paid $308,000 a year? Sorry, the LLC is worth $24 million. After 20 years, it's worth $31 million. Yet the husband's estate is only going to stay at $8 million. The wife's estate stays at $8 million. So you have $31 million in assets, but the estates are only $16 million. Here's a simple spreadsheet that shows you that what you're saving in estate tax is very, very significant. It shows you the year-by-year growth at 5%, the annual note payments, and what is left in that trust, quite a bit. So that is the installment sale to the defective grantor trust and the use of a spousal limited access trust. So now let's go to the next polling question, and it is at page 106. So I click there and I go 106 and I hit enter, and there it is. So this is a fellowship fund that our law firm has established at Stetson University College of Law, and 2 students of color will be selected to receive the fellowship, they will be honorary members of their choice of the Suncoast or Pinellas County Estate Planning Councils. They will go to the council meetings. They will develop curriculum for a program for communities in need to learn more about estate planning, in particular guardianship and the disposition of homestead and the need for a simple will and otherwise. They will also speak with me at the annual All Children's Johns Hopkins Conference in May of 2024 on hot topics, and they'll get money. So not a bad gig. If you would like to sponsor a similar arrangement in your estate planning council, or if you know the proper spelling of the word council in this situation, then please answer our polling question. A, you're interested in sponsoring a student. B, you're interested in participating in a diversity acceleration workshop that I'll be putting on by video, by conference video. C, if you would like to volunteer to mentor a law student of color. Or D, the number we have dialed is out of service. Or E, next question, please. So the count is on. Please make your decision. This could be one of the most important decisions in your life if you really want to help somebody dramatically, which we thankfully have the opportunity to do. And onward. I want to mention briefly basis step-up planning. Basis step-up planning is when I die under the U.S. tax system, if I have IBM stock that I paid $10 for and it's worth $100 when I die, and my family sells it 10 days after that for $110, they only pay the capital gains tax on the $10. It gets an income tax basis equal to what it's worth when I die. And that's called a stepped up basis. It has nothing to do with the Tom Waits song, Step Right Up, from the Small Change album, which is definitely one of my favorites. If you like good lyrics, you definitely need to listen to Small Change by Tom Waits. It's a great album overall. The better album, though, is The Heart of Saturday Night, which is my favorite Tom Waits album. In any event, stepping up this program to talk about the stepped up basis, the question becomes, should I own the assets? Because if I die first, there's a step up. Should Marcia own the assets? If she dies first, there's a step up. Should we set up a special schmancy fancy trust called a joint exempt step up trust? I'm not jesting, JEST, that may step up all the assets on the first death. Do we put our assets in an Alaska or Florida community property trust, which steps them all up on the first death? Alaska later. Get it, like Alaska, Alaska? That's the best I could do. But it gets even better than that. Because, and by the way, if you have depreciable real estate, in other words, you have a warehouse or an airplane and you've written it off, you've depreciated it, and now your loved one is about to die, so sad, you put it in their name, it gets a step up, and you take the depreciation all over again. It definitely lightens the funeral up a little bit. So the really cool thing that's going on, and it did not make the Biden list, so please don't tell anyone in the administration about it, is I could have my father-in-law be a beneficiary of a trust for my children and my spouse, and give him a power of appointment to appoint the assets to creditors of his estate, but only with the consent of my best friend from high school, my best friend from college, and my best friend from law school, which happened to be 3 different people. So he would need the consent of one of them, and he would need to set up a will leaving the assets to creditors of his estate. And then if he died, some of the assets would go to creditors of his estate. That's a bad thing. But he wouldn't be able to do that. My friends wouldn't let him. And when he dies without exercising that power of appointment, the assets in the trust get a step up in income tax basis. You know, it's sad when you lose your parent or an aunt or an uncle, but it's nice to get a step up in income tax basis. And you can leverage that. In other words, what if I put, he only has a $12 million allowance, and let's say I have $15 million worth of assets in the trust. Well, I want to limit his power of appointment to $11,990,000 because I don't want him to have to pay estate tax. But what if I give him a power of appointment over an LLC owned by the trust, and the LLC owns the trust $2 million, so the LLC is worth less than $12 million. Yet it may have $14 million, $16 million, or $30 million worth of assets. Will that work? Well, there's no IRS rulings on it, but there is some pretty good law to the effect that it should work. There's many exceptions in this step-up basis planning. The best materials, or the most original materials for sure, are by my friend Ed Morrow, M-O-R-R-O-W, the OBIT trust, which is kind of like a play on words. It stands for the new basis type of trust, but when you read about them in the obit, you get your step up, you get it? It's a really good outline from 2018. Ed will be glad to send it to you if you ask, or I'll be glad to send it to you if you ask. And then there's even an IRS ruling, 2022-06008, which came out last year, where the IRS pretty much recognized how this works and did not complain about it, and said it did no harm to a GST exempt trust. Okay, so for those of you who want to leave at 11:50 because you just want to get your CPE credit and get out of here, here is the last, I promise, the very last, but the very best polling question, because you get something free. Would you like to receive for free a copy of our book by PDF, 8 Steps to a Successful Estate Plan, or that's A, B, the Florida Physician's Guide to Creditor Protection, C, the book that I wrote with Wall Street Journal best-selling author David Finkel and Dr. Parik Singh, Grow Your Medical Practice, or D, what estate planners and others need to know about bankruptcy. So, big round of applause here to David Finkel for letting me write the book with him. And thank you very much for being here 3 more minutes before you get credit. The rest of us are going to be here till about 12:10. I may come back to Cupert's today in the next 23 minutes, but I probably won't. I want to make sure that we cover Gratz today. Why? Because I have some clients that I'm working with Gratz on, and I made a special slide for them and others that I'm anxious to share. And also I'm going to talk about charitable lead annuity trusts. Now, if you've watched part 1 and you've watched part 2, then please watch part 3, where I hopefully will cover most of the rest. This area of the law, by the way, is very, very complicated. I am oversimplifying it. Every week, our law firm, which has 4 lawyers who do this, go and get help from other specialists in sub areas of estate tax planning. Don't try this at home. Anyone who does their own legal work has a fool for a client. That's an F. Lee Bailey quote. Okay, what is a grantor retained annuity trust? Well, one answer is it's something that doesn't appear to be on Biden's hit list, which I was glad to see because it was on the hit list before. GRAT stands for a grantor retained annuity trust, and it is statutory, which means it's specifically permitted under Internal Revenue Code section 2702, which is, ding, the code section of the day. So you could read code section 2702, you'll be completely confused and therefore willing to hire somebody of my profession. By the way, could I have a cough drop, please? Everyone's asking me not to cough as much. All right, so I'm going to give you an example of a GRAT here. This is a grantor retained annuity trust. Thank you very much, Brittany. With a grantor retained annuity trust, I have signed a trust agreement. And the trust agreement says that when I put assets into this trust, I will receive back 2 payments over 2 years. So these payments, and this example is based upon a prior 75/20 rate, but very close to what it would be now. The 2 payments, payment 1 would be based on 49.4208% of what I put in. And payment 2 would be based on 59.305% of what I put in. And anything left in that trust after the 2nd year is out of my estate for federal estate tax purposes and can be used for the health, education, maintenance, and support of my spouse, and my spouse can have a power of appointment over it. Now, most GRATs haven't worked that way. Most GRATs that clients tell me about, they bring me, they put it in the GRAT, and after the 2nd year, it's for their descendants only. But you can make one for your spouse, so your spouse can oversee where it goes and even benefit from it if they need it. That would be called a lifetime bypass GRAT. Now, in my example, I put in $4 million worth of assets. I get a payment of $1,976,000 the first year, and a payment of $2,372,000 the 2nd year. Now, anything left over after that is left in the GRAT, estate tax free. How much of my gift tax exclusion do I have to use to set up the GRAT? The answer is 0 or almost 0. Some of my colleagues like to have that remainder interest at $1,000 or $5,000. Some of my colleagues put it at 0, so you would not have to file a gift tax return informing the IRS that you did the GRAT. It is safer to file the gift tax return because then the IRS only has 3 years to challenge the GRAT. So this is one of those nothing to lose strategies. If the assets I put into the GRAT go down in value, then I'm just going to get whatever they're worth in the first 2 payments. If the assets that I put in go up in value, then that excess over the hurdle rate, which is now 4.2%, is out of my estate. One disadvantage of the GRAT compared to the installment sale is that what's left in the GRAT after I get my payments back has to be generally, in most circumstances, in the non-GST mode, which means it may leave a couple $1 million in lifetime trust for my wife and children, but on the death of my last dying child, it will be considered as owned by that child for estate tax purposes. So that's a disadvantage of the GRAT. An important advantage of the GRAT over the installment sale is that Internal Revenue Code section 702 specifically says, and the regulations under that code section specifically say, that if I mismeasure the value of what I'm putting into the GRAT, then instead of having to pay a gift tax, I receive higher payments back. So in other words, my GRAT says I'm putting in stock of this company, or I'm putting in this piece of real estate, and I think it's worth $4 million, so I'm going to get payments back of $1,976,000 and $2,372,000. Well, the IRS comes in and says, no way, this was worth $6 million. You made a $2 million gift. Give us gift tax on $2 million because you've also used your whole exclusion. And I can come back and say, no way, that's not the way it works. Instead, my first payment should have been 150% of $1,976,000. My second payment should have been 150% of 2,372,000. So I don't have a gift tax risk. Now, if I don't have a gift tax risk, then the IRS is less likely to audit me. Another feature of the GRAT is that the annual payments back can be equal annual payments or can increase by 20% a year. So I can go to my little software program and say, I'm going to do a 2-year GRAT. The 75/20 rate is 4.2%. What would my equal payments be? Oh, about 52.4%. What would it be if I take out the lowest payment the first year and a higher payment the second year with a 20% differential? Now the first payment is 49.42%. The second payment is 59.3%. And then you ask me, why is the GRAT in a circle and not a square? And the answer is because this is a rolling GRAT. It has nothing to do, now a rolling GRAT has nothing to do with a cigarette. A rolling GRAT is a grantor retained annuity trust where you put the assets in, and as soon as you get your first payment back, you put that in another GRAT. And as soon as you get your second annual payment, you put that in another GRAT. So you always have GRATs going. So if you have a bad year in the stock market or a bad year in real estate, whatever you're gratting with gratitude, that's where the word gratitude came from, the Latin word grat, grantor retained annuity trust, invented by Julius Caesar, and that's where the word gratitude came from, for those of you who were not here when they invented the internet. So you want to do these rolling GRATs if you want to keep your assets above 4.2% at the present hurdle rate out of your estate. Now, do you want to do multiple rolling GRATs? And the answer is yes, because let's say I do a rolling GRAT for my foreign investments and a rolling GRAT for my domestic portfolio. And foreign goes up, hooray. Everything above 4.2% is for my kids. And domestic goes down, boo-hoo. It doesn't bring foreign down, I just get 100% of it back. So a lot of clients do multiple rolling GRATs. Not that expensive to do because one GRAT looks just like the other. And each year we may update the GRAT form, but it's not an expensive process to do rolling GRATs. The other thing I'll mention is you can make the payment up to 180 days late. So if things are going well and you want to extend this thing, you make your first 49% payment at 1.5 years, and you make your 59% payment at 2.5 years. So more is locked up in the GRAT. So now I want to show you a 5-year GRAT. There it is. So this is one exhibit you can use for your clients, or you can show it as 2 exhibits. So you have the top on page 169, page 168, the bottom on page 169. I like to do everything on one page because it's easier to remember. But assuming that you don't have a microscope there or a magnifying glass in front of you, I'm going to show you a GRAT. So you have Sam Smith. Sam puts $12 million into an LLC, and he transfers by gift 99% non-voting member interest to the LLC. And that 99% non-voting member interest is valued at only $10 million because it's non-voting. Well, a 5-year GRAT making equal payments over 5 years will pay $2,271,000 a year. And what's left over after the 5th year will go to the descendants. And if the assets will grow at a certain rate that I'll show you, then what's left for the descendants after the 5th year is $4,300,000. So you put 12 million of assets in, and at the end of the day, 4,000,003 is in a remainder trust for your spouse and descendants, whether you like them or not, never subject to federal estate tax, and this used 0 of your estate tax exemption. Now, we can also talk about a set of encyclopedias if you don't have one, but that will be later. So how did these numbers work? Well, we put 12 million in the LLC. We took a very small discount, a 16.67% discount, which is, I think, very conservative, even taking into consideration that the LLC will make distributions to make the GRAT payments. And the 12 million grows by 8% a year. So you end up with 960,000 added, and then the annuity payment to the grantor of 2,271,000. At the end of the 5th year, you have 4,003,000. Now, if we didn't use equal payments and we had payments that started much lower, went up by 20% a year, then we would have more at the end of the time. If we didn't make the payments until the 180-day mark, we would have more here. And if we had the child as the trustee of the trust and paid the child a trustee fee, we would have more out of the client's estate. So that is the GRAT, and it rhymes with the cat in the hat. What do you think of that? There's another GRAT example here that I want to show you, and this is a company, and the company shoots off $3 million of income, and it's worth 5 times earnings, so it's worth 15 million. So the client values 10% of the company at 2 million and does a 10-year GRAT. So what happens? For 10 years, the GRAT receives 300,000 a year. It uses that to make a payment of 119,000 a year. And after the 10th year, the GRAT is out of the estate. So you have 300,000 of dividends you're receiving minus 119,000 of payments paid out. At the end of the 10th year, assuming a 7.5% annual return, the GRAT has 2,000,005 plus owns 10% of the company. The client has received back only 119,000 times 10. So GRATs work really well for S corporations, partnerships, real estate where you have rent income. So think about the GRAT. That is what I wanted to say about that. But then, my friend, you have the CLAT. If you will look at page 168 of your Apple Mac, the CLAT works similar to the GRAT, but allows the family to save estate tax while also making payments to charity that can generate charitable income tax deductions. So here is what a CLAT looks like. And I'm sorry I stopped rhyming. I just ran out of words that rhyme with the word that. Okay, so I've got a new LLC or an old one, and I still have Sam. Sam puts 13 million of assets into the LLC, and he gifts 99% non-voting member interest to the LLC. To the Charitable Lead Annuity Trust. The Charitable Lead Annuity Trust will pay $76,211 a year to Sam's Family Foundation, which is run by Sam and his descendants, for 20 years. Sam will get $1,300,000 charitable donation income tax write-off at the time that he funds this, but then he'll pay the tax on the $76,000 a year. He still comes out ahead. The charitable remainder trust at the end of the 20-year term will pay his descendants what is left over, which in this case, $848,450. So let me show you another, or let me show you a slightly different example here on page 172. You start off with $1.3 million in the CLAT. The CLAT is considered to be a $1 million charitable gift, not $1,300,000, but a $1 million charitable gift because of the discount you took. The CLAT grows at 8%, 8% of $1.3 million, $104,000 a year. The CLAT pays $76,211 a year to charity. And then the charitable deduction benefit for this client was somewhat limited. The end of the day value going to the children is $2.571 million. So this is a 20-year CLAT. And at the end of the day, charity has received $1,524,000, and the children have received $2,571,000. So look at that and tell me, would you rather leave $10 million to go $6 million to the IRS and $6 million to your children and $4 million to the IRS? Or would you rather leave the assets about $4 million to charity and about $6 million to your children? And you're going to say, obviously, the charity, not the children. But then I'm going to have to tell you truth in disclosure. One of my favorite books in undergraduate school was How to Lie with Statistics. So I don't want to lie here with statistics. Charity gets $1.5 million, and my children get $2.7 million. $2.5 million. But my children have to wait 20 years for that. So what's the present value of what goes to charity here? It's about $1 million if you use a discount rate of 4.4%, because charity has to wait. It doesn't get all its money up front. It gets it over 20 years. My children don't get a single payment for 20 years. By the way, that serves them right. So now I have a discount that it comes out to about $1 million. So what I tell clients is, oh, and by the way, the children can be the trustees of the CLAT and receive compensation, and they can be the officers of the charitable foundation and receive compensation. So maybe they'll receive 1.5% a year, which will make a difference. But in any event, I think the question for the affluent client is, would you rather definitely pay 40% estate tax, or definitely not pay any estate tax and have maybe half go to your children and half go to a charity controlled by your children? And by the way, if you do this, you don't have to worry about grats and cuperts and all that stuff, because assuming they don't change the estate tax system, the CLAT is where it's at. And if you're concerned that they may change the estate tax system, why don't you do a gift CLAT now? Why don't you go ahead and put 10 million of your 100 million in a CLAT today, get your income tax deduction, watch it happen, be here to nurture it, and if you like what you see, then your estate plan can empty into a CLAT. Now, here's what Jackie Onassis Kennedy did, or Jackie Kennedy Onassis did, besides go around on a boat a lot. She left an estate plan very similar to what we have done for some clients. She did it before us, though. She said, I hereby leave my assets to my son, make that to a trust for my son. But if the trustee of this trust disclaims it, then instead of going to my son, it's going to go to a CLAT, and it's going to be a 20-year CLAT. It's going to receive all my limited partnership interests, so there's a discount. And at the end of it's going to make annual payments based upon the guidelines that exist at the time of my death, so that there's zero estate tax. And in the 20th year, it's going to be available in trust for my son. So on her death, her children were able to decide, do we want to pay the estate tax and get it, or do we want to have the trustee disclaim it in whole or in part, let it go to the CLAT, fund a charity in her name, and use it for charitable purposes and pay no estate tax. Now, reportedly, her children, or the trustees for her children, decided not to use the disclaimer. And I wasn't there, so I don't know the reasoning behind that. But I think you can see that CLATs are an extremely powerful way to leave assets both to charity and to the family. So I want to go ahead and see if there are any questions here. Okay, I just accidentally closed the question box. Let me see if I can find a way to open the questions box. Brittany, you have any ideas for me? Did I lose the question box?
Yeah, you did.
Okay.
Oh, there it is.
There it is.
Just drag it off.
We'll drag it up. There we go. Okay, the first question is, are you muted? The answer is, I hope not, or I just wasted an hour and 10 minutes of everyone's time. The second thing is, it's www.nationalmuseum.af.mil for the National Military Museum. Thank you, Glenn. I'm looking forward to seeing that museum the day or before or after that Dayton, Ohio one-day conference, which becomes tax deductible, by the way. Okay. Next, please provide a link for Article 51 Harvard Business Review. It's the Harvard Law Review. It's 51 Harvard Law Review, Perpetuities in a Nutshell by Leach, and we can send everybody the information on that. Now, The Cat in the Hat is a better book, but it's shorter. How does the alternate valuation date work for step up? Kathleen, that is a great, very good question. When a person dies, you use the date of death for estate tax valuation, but if the assets are worth less than that 6 months after the date of death, then you use the alternate valuation date, which is 6 months after date of death. But you still use the date of death for the income tax basis step up. Okay, the next question is, a grantor retained annuity trust disregarded for income tax purposes? Yes, David, a grantor retained annuity trust is, for income tax purposes, disregarded, so that the grantor is paying the tax on behalf of the trust, so the trust can grow estate tax and gift tax free. The next question is, how is a CLAT taxed for income tax purposes? Well, while you're living, there are two different choices. You can have a disregarded CLAT where the grantor is considered to be the owner of the CLAT assets. That's called a grantor CLAT. And the deduction is based on the assets you put in the grantor CLAT. You can also have a non-grantor CLAT. And you know what? Before we get all mixed up and I get all mixed up, I'll cover that in the first part of my presentation next week, if anyone shows up. Okay. Any other questions? Where can I get a copy of your PowerPoint? Brittany, can they download the PowerPoint? Okay, you can download.
It's in the handout.
It's in the handout section. And also, can you email them the PowerPoint? Okay. All right. Well, I went beyond the hour. Many of you are still allegedly listening. I hope you have a fantastic weekend. Please use this information to help others, to help charities, and to help yourself. Thanks again. And if I was in Hawaii, I would say aloha. Was it off yet? Turn it off. Hurry up. I'm done. Turn it off.